Okay, let's talk about the next question, which is obviously related. This early stage fundraising has to be done properly. And there's obviously a big debate. And this question comes from Lauren. What's better? Should I sell a convertible note or should I do a Series Seed stock? I guess a priced round is what we would call it in the business. What's your take on that?
We obviously get this question a lot too, and frankly, your insight's going to be equally valuable to the group here. I think before the days of Series Seed, right, when that was sort of institutionalized, and now there are these open source documents out there in the world that when folks say I'm selling Series Seed stock, we all know what they're talking about, which is pretty much a liquidation preference and not very many other rights and preferences that would be typically associated with a Series A. Before that, the delta between do I want to go through the whole rigmarole of selling Series A stock and negotiating all that, or just doing convertible notes, there was a pretty big divide, cost, time, energy. And so a quick infusion of capital for something less than $1 million, everyone sort of trended towards a convertible note. Now that we have this other alternative, right, which is a Series Seed, really slimmed down preferred stock, and now that notes have a cap on them, right, you kind of are talking about the same thing, right? You're going to have a quick infusion of capital. You either are going to put someone on your cap table as a note holder or as a stockholder, and it really just comes down to preference. In some regard, there has been some, and this is slightly tangential, there has been some question about is convertible debt really the best thing for a young company when they don't know how their progress is going to go, if they're going to really be able to make it to market, if they're going to be able to achieve those milestones, because convertible notes, by definition, have that ticking time bomb associated with them.
Right.
As a result, convertible equity is something that we talk more and more about, which is effectively exactly the same thing, but for the fact that there's no maturity date on it.
Right. So the loan of a convertible note becomes mature after 18 months typically, or 24 months?
Sometimes 12.
Sometimes even 12, which means there has to be a hard discussion between the investor and the people who are running the company and say, hey, we can now, either you pay us back, we can call the note, and we could own the company before close.
Exactly.
That never happens. Have you ever experienced that happening?
Not with folks in this ecosystem. But when and frankly, I just had a company who took money from, we'll call it another jurisdiction, and actually the investors did decide to foreclose and hold the asset. I mean, that's obviously a travesty, and everyone is traumatized and they've lost their company, but it doesn't really happen here, right? Folks know the game pretty well.
I think that's something important to highlight is the benefits that we get through the startup ecosystem, whether it's here or Santa Monica or New York. Geographies where people really understand this type of investing. I don't think that you can underestimate how valuable that is as a founder, because having people that know kind of what's the norm and how this is going to work can make it much, much quicker to get your money in the door and into your bank account, and the negotiations much shorter. Expectations are just more well aligned. If you get someone, say a Wall Street type, who has a totally different conception of what preferred stock is, they look at it entirely differently, and you say, I'm going to sell you preferred stock under the Series Seed documents. I mean, it could be a very long road to closing, because they're going to look at those and say, well, this doesn't relate at all to what I'm accustomed to for terms of a preferred stock offering. So I think really focusing on your investors and whether you go
picking the right ones, right?
Yeah. Whether debt or equity, to me, is a little bit of a secondary issue compared to picking the right investors and making sure that people are really going to understand what the investment is and really be more supportive beyond just the dollars that they're putting into your bank account.
Hey, Todd. So when the note matures, what do professional investors suggest founders do? What does a professional firm like Wilson Sonsini suggest you do?
What we see most typically is an extension, and it's either explicit or implicit. A lot of the notes are only they're only callable if there's an action by the investors to call the note. So it can sit there.
They can do
nothing.
nothing.
Mature and do nothing, right?
I've seen people do nothing, which technically is an incorrect way to do it.
Not necessarily.
Is it not the most button up, or?
Well, it depends how the note is drafted. Oftentimes it allows for that. It says, once you hit maturity, if the majority and interest of the note holders decides to call the note, then it becomes due. Otherwise, it just hangs out there. You're past the maturity date, and it's just a risk. And you are
a risk for the founder, really.
Right.
Exactly.
So it's in the founder's best interest
at any time they can make that decision to call the note, which is a little bit of an uncomfortable situation if you don't have a great relationship with your investors.
I've had it happen like one time where like the company was doing so poorly that I was like, well, I guess they're not really getting back to us. The company had gone kind of AWOL. But in that kind of situation, a professional investor who's put 25 or 50K in writes it off and says, this isn't worth my bandwidth.
Right.
I mean, that's why it's, I think, good to get professional investors, because they would look at these kind of edge situations as not worth their time, I think.
I think that's exactly right, because you look at what are you going to do if you try to foreclose on the note? Like, what's there? Oftentimes,
a domain name.
Yeah, a domain name. There's very little in the way of value in tangible assets. The IP is probably half formed and not of much value without the founders there to implement on it. So most people just walk away.
You were going to add to that, Rachel? Yeah.
No, I mean, I think we spend a ton of time dealing with these particular issues, and I think it really is fundamentally what has happened, right? Because there's sometimes a moment where an investor might say, I'm going to double down. You're very close to hitting where you need to be, so I'm not going to call the note. And in fact, I'm going to give you a little bit more to get to that next milestone, when then we as a group can go out and raise broader funds to support our next generation. But I think the key is, what's the state of the company at that time? And then to your point, what's the type of investor, and are they going to have the appetite to manage this?